How can you as an investor determine if a startup company is a massive risk or a smart bet? Well, I'm Santiago, and I've helped clients with over 9-figure investment portfolios make these decisions. And in this video, I'm going to walk you through a step-by-step framework that's going to add structure around your decision-making process to know if a startup company is just a good idea and you can think like a professional investment analyst. So let's start out with first things first. You're always presented with a good idea. Everybody always has a good idea what to do with your money. And they present you this idea and they say, hey, this is the next big thing. You have to invest in this. And you, as the investor, are trying to analyze if this is a good investment, if this is a good idea for your money. So in step number one, what we want to do before we look at any idea, before we look at any investment, any business, we want to understand, what are we getting? What are we investing in? And what are we getting in return for our investment? So when you are investing in a startup, any startup that's raising money is going to either raise it on a pre-seed or pre-revenue status, or it's going to be a series raise. The series order goes by series A, B, C, D, and so forth. More than likely, you will be approached in either the pre-seed stage or a series A or B round, the early stage of the company. And you as the investor want to know, okay, where are you at? What am I getting for the capital that I'm giving you? What stage are you at? So for an example, let's say we're in series A. This company is in series A. Next, after you understand where the company's at, you want to understand, what is the valuation math? Valuation math being, before you raise this money, what is your company valued at? And after you raise this money, what is your company going to be valued at? This is also known as the pre-money and post-money valuation. So easy math that you can do as an example, let's say a company is raising $10 million for a 10% ownership stake in their company. This means that the company is going to be worth $100 million post-money, and pre-money, it's worth $90 million. So instantly, we know what we're buying in. We are investing in this company as an equity owner at a $100 million valuation. After the valuation math, you want to understand the term sheet. What is a term sheet? A term sheet, in easy terms, is simply all the terms that you are going to be investing in as an early stage investor. If you look here, we have what's called liquidation preferences, and this is one of many things that will be listed in the term sheet. But as you can see in this example, just us understanding the liquidation terms could have a massive impact on the future of our investment. So before evaluating an idea, looking into the numbers, looking at the total addressable market, we as investors have to understand, no matter what are we getting for what we're buying? After we understand what we're buying into, if those all check out, we move to the next step, which is understanding the leadership team. Any startup, the leadership team is going to have a big influence on the success and failure of the investment. Is the leadership team completely dedicated to this investment and the business? There's a good saying out there that says founders that don't plan on sticking around with the company for long end up running the company forever. So many times I interview founders that are trying to raise money and they say, hey, in 3 to 5 years, we plan on exiting this business. And in theory, this isn't a big issue. Companies get acquired all the time. This in itself is not a problem. The problem is that imagine if you had this great idea that could potentially make you millions, if not billions of dollars. Would you today, if you were completely dedicated to this business and this investment, be saying, hey, well, in 3 to 5 years, I plan on just selling this idea off? No, you would want to hold on to this. You would want to be dedicated to this. And this is the type of founding team that you need. You need founders and a leadership team that's all in. They're dedicated to the business because that's what it's going to take to make a business successful. If somebody is already planning their escape plan, think about a relationship or a marriage. If you go into it already with a backdoor plan to get out of it, is that the type of person that you want to be in union with? The same applies to investments. You want to be in union with the leadership team that is completely focused, completely dedicated on driving results in the business and also driving the result for your investment return. To add to the leadership team, You want to evaluate their domain expertise. Do they actually have experience in what they're doing, and what is their track record? When it comes to their track record, if they have past failures, that's not necessarily a bad thing. You can learn from failures, but you need to evaluate, do they have experience driving results, motivating people, recruiting great talent, driving a business forward, or is this their first time at it? A part of the experience in evaluating the leadership team, I will add in the leadership's charisma. Why is this important? Well, if you can't motivate anybody, how are you going to raise money? If you can't motivate anybody, how are you going to convince the world of your idea and what you're trying to put forth for your business? You know, all the great CEOs, Steve Jobs, Elon Musk, they are really good at getting others to buy into their idea. There is a bit of gamesmanship when it comes to startups, venture style investments, where the CEO has to be charismatic enough to get the buy-in of other investors and drive the valuation of the company. That's going to benefit you as an investor. Imagine if I got on this camera right here and I'm trying to convince you to invest in my company or YouTube channel, and I say, well, I have a good YouTube channel and, we're going to make videos every week, and in 3 to 5 years, you're going to get a return on investment. No, you need a leader that's charismatic. You need a leader that can motivate others to invest in the company. So evaluating the leadership team is step number 2. You need a solid leadership team that has domain expertise. They're dedicated to the company and they have a lot of charisma to deliver results. Now, if you noticed, I said that there were 4 steps, and we're halfway through and we haven't talked about any total addressable market. We haven't talked about any numbers. And if you just do the first 2 steps, evaluating what you're getting and evaluating the leadership team, if those 2 don't check out, you can save yourself a lot of time and energy. The first 2 steps often just get completely looked over, right? We're presented a startup investment idea and we're so focused on the idea that we never actually take the necessary first 2 steps to see, like, 1, does this actually fit what I'm trying to do? Do the terms make sense? Does the valuation make sense? And 2, is this a leadership team that I can get behind? Doing these first 2 steps can eliminate a lot of nonsense from what you would be investing in the first place and save yourself a lot of time, money, and energy. If these first 2 steps check out, we're going to transition to the following 2 steps. So step 3 is going to be our valuation methods. We need to take some numbers, make some assumptions, and see if this investment has the potential of giving us a 100x. Notice I said a 100x. That seems lofty, but realize when you are investing in startup companies, there is inherently a high failure rate. So when you are taking that step, you need the potential of a 100x. Doesn't mean you're going to get the 100x, but you need the potential. There are 3 valuation methods for startup companies. We have 1, our discounted cash flow. We have our VC method, and we have comps. Each have their pros and cons, and there is not a right or wrong way, a better or worse. You need to determine for the business what makes the most sense given the business's current situation. So for example, if you're dealing with a business that is a Series B raise and has a bit of history of sales, revenue, maybe the company is already profitable, a discounted cash flow may make sense because you can project out into the future using some reasonable assumptions. How is this company gonna fare out? Do the numbers check out? Does it make sense? Can I get a 100x? If you are dealing with a pre-seed company, it may make sense to use the VC method where you're looking at a future projection and you're saying, hey, this company doesn't have sales now, but based on the total addressable market, based on the technology that they have, I see the potential for 100x given reasons A, B, and C. And then you have your comp methods. Comp methods are typically good when there is a stiff competition in the marketplace. There's a lot of companies that may be already doing what you're trying to do, and you have a unique edge at what you want to do. I'll give you a quick example. Uber and Lyft. If you created a different form of a ride sharing app, you could look at Uber and Lyft's success so far. You can look at their trading comps when they took their company to the public market and create comps that allow you to judge the market. So each one of these is a different way of evaluating a company, but you need to decide which is the best valuation method for your startup that you're analyzing, run the analysis, and then see if you have the potential of a 100x investment. For this video, in the description, I've included a venture capital AI prompt that you can use to get started on evaluating potential startups and the potential of a 100x investment. Go ahead and click the link in the description and access my AI prompt that helps you evaluate venture capital investments. And finally, step number 4 is our grading system. There are many ways to grade an investment. The point here is you want to have a system and you want that system to be consistent. So let's break down an example of what a grading system would look like. Let's say that I want to evaluate investments and I want to put a 50% weight to all of my investment decisions based on the leadership team. I think that the leadership team drives results, and 50% of my decision making is based on leadership. 25% of my decisions are based on the valuation that I come up with, and the remaining 25% is based on the term sheet. This is a form of a grading system, and you can adjust and create your own grading system for what you think are the most important factors for evaluating a startup company. With that being said, as a professional investment analyst, this is an art, not a science. There is no tried and true grading system. You need to choose the grading system that makes the most sense for what your investment objectives are. If you don't know what your investment objectives are, you need to sit down with an investment analyst or a financial advisor and simply just determine what are your investment objectives. What is your time frame? What is your risk tolerance? How much money are you willing to lose if this investment doesn't work out? This will help narrow down the focus on how you can create a grading system that makes sense for you. Creating this grading system is going to allow you to remain disciplined, and it's going to allow you to create a methodical, structured method for making decisions so that you are consistent. Not being consistent opens the door for a lot of leaks in the bucket, because you may make one investment based on these decisions, and then you get another investment opportunity that's based on these decisions, and it's not consistent. Consistency is key so that you can evaluate what's working, what's not working, and move more towards what is working, right? What is the system that has been created that allows us to be successful? Any great venture capital firm, any great investor has a methodical system for making decisions. And this is what we do as investment analysts. We look at the facts, remove the emotions, and create a system that allows us to identify the pros and the cons to every investment and see if the pros outweigh the cons. So now that you know all about the 4-step process on how to evaluate startup companies, you may be wondering, how do I evaluate established companies, companies that may be traded on the publicly traded stock market? If you want to know my method for evaluating established companies, go ahead and visit my video on how to evaluate stocks where I evaluate Palantir, linked above.